Well, startups had it pretty good through the recovery as easy money allowed early stage companies to fundraise. But with the Fed pulling the punch bowl and concerns of a recession shaking up markets, the risk is now real that companies will have to take funding that actually lowers their valuations. You can see it's been shrinking the amount of down round funding in this chart, but could that uptake? Let's bring in someone in the venture capital space for the answer. Jordan Knopf is Tusk Venture Partners co-founder and managing partner. Jordan, great to have you on the program this morning. There's been a lot of chatter, a lot of discussion about how the environment for venture capital funding has changed just over the last few months. Kind of curious just to get your take from Tusk Venture standpoint.
Yeah, we've seen a pretty stark contrast in the last few weeks, particularly as the correction that has happened in the public markets has trickled its way first to the later stage rounds of financing and then ultimately to early stage venture capital.
Yeah, I mean, can you elaborate a bit more on what it is that you're seeing?
Yeah, absolutely. There's a few elements that we're seeing. One on the deal pacing side. So the number of new deals that are getting done is definitely slowing down. So I think that is due to a couple different reasons. One is VCs typically end up spending a little bit more time with existing portfolio companies. One, and then two is they're really kind of they're adjusting the reserves that they have for other existing portfolio companies in the case that they need to extend that company's runway. In addition to that, if they are due back to market to raise a subsequent fund, they may want to postpone that just a bit, as you can imagine, a lot of institutional investors are reallocating capital into what they perceive as lower growth names and more stable companies.
And Jordan, we've seen a number of VCs come out and release these decks to portfolio companies who essentially saying, look, this is a time to shift your focus to profitability. That's what the market's looking for, even on the private side of things. And I wonder what the conversation is like for you and the companies you've been investing in. What are you advising them?
It's a great question. And I think that a lot of the themes that we've had across the board and alluding to the decks that you had mentioned are really a refocusing onto a core business strategy and really separating out the haves and have-nots. So extending out their runway, reducing their cash burn. And that can look like a couple different flavors, whether that's stopping some additional adjacent market expansion. It can look like a reduction in headcount. And it's something that, when taken very seriously early on, can be the difference between a company that ends up making it and one that doesn't.
So are you worried about a lot of companies not making it in this environment? Because, for some companies that have been on the high growth path for the last, let's say, 2 or 3 years, if the money dries up and they no longer have the money to make the CapEx that they need to get to the scale that they can really be profitable at, then do they just go under?
So that's what we're all trying to avoid, and I think that's where that takes a lot of prudent cash flow management and investment discipline on both the company side and on the VC end. So I think that you start to see refocusing on less tech-enabled businesses and more on software, higher margin and lower CapEx businesses, and that's what we're definitely seeing trickle down to the early stage.
Jordan, let's talk about where Tusk Ventures is investing. You got a pretty even split between East Coast and West Coast companies, but I thought it was interesting. You've also got about 20% in what we call other areas, places like Colorado, places like Texas. I wonder if you think that pie is only going to grow given the relocation of talent that we've seen over the course of the pandemic.
Yeah, we are starting to see companies that have moved to being remote first or a hybrid model. That some companies, obviously there's been a lot of growth in the Austin, Texas area and Boulder, Colorado in particular. So those are definitely emerging hubs. In addition to that, you'll see a lot of growth in Miami. But I would definitely say that the vast majority of companies that we are seeing still are in New York, which is where our entire team is, and also on the West Coast.
All right, Jordan Knopf, Tusk Venture Partners and co-founder and managing partner. Thanks so much for the time today.